Hello and welcome to the Chamber Music Mindset. I am your host, Anna Rathbun, the founder and CEO of Granadilla Advisory, LLC. Okay, so today I would like to provide you with a recap of last week, but not just the news, some of my thoughts on what I thought was important and highlights from the earnings season. And I want to talk about what's coming this week. Especially the Federal Reserve decision that we're anxiously waiting for at 2 p.m. on Wednesday. I think it's July 30th. Okay, so what happened last week? The S&P 500, I'm just going to generally call that the markets, continue to advance upwards. Right now, the market is trading off of the headlines. There's some changes underneath at the stock level because we are in the throes of earnings season. But it's basically all about trade. And so last week we had some deals that were made between the United States and some Asian countries, notably Japan. Over the weekend we had one with EU as well, and we'll see how the markets react today on Monday. But it was really about Japan, and we decided on the 15% in foreign tariffs. But the big news there was the $550 billion of foreign direct investment that's coming in from Japan into the United States. Now, that is a big deal. That's a lot of money. No one really knows where Japan will get this money. But that is definitely a part of the deal, and the markets really liked it. Now, underneath the headline news and headline S&P 500 movements, we did have stock movements, right? So I am going to pick on a stock, but before that, I will say the earnings season is going relatively well. According to FactSet, I think we were expecting about 4.9% year over year earnings growth. Right now, we're at over 6%, which is not too bad. That is with 34% of S&P 500 companies reporting. 80% of that 34%, they're beating on earnings and earnings expectations, and they're also beating on revenue expectations. So certainly the performance has been very good. Now, what have the markets been doing other than trading off of the headlines? The markets have been punishing these companies that are meeting expectations and certainly not meeting expectations. So if you were meeting expectations, you can expect a loss in 2-day performance of about 2.7% on average for meeting expectations. If you're beating expectations, so you're outperforming, you're only seeing 0.4% on average on the upside. And then if you don't meet expectations, so you're underperforming, you're getting whacked. So that's negative 6.1% as a 2-day price action on average. So there's definitely a lopsided upside and downside to price movements depending on whether or not you're outperforming or underperforming. And this is, I'll just say, what happens when the market is so expensive and the stock market is priced for perfection. You really better outperform and wow the markets in order to be rewarded with an upward price action. Okay. So let's talk about GM. And why am I picking on this stock? I'm picking on this stock because GM is an auto company and they're very much dependent on trade, international trade, and therefore it's a good barometer for tariffs. So what did GM tell us? GM reported a 35% year over year reduction in their profits. 1.1 billion of that was a negative impact due to tariffs. $1.1 billion. That's a big impact, and the markets didn't like it, although we were all sort of expecting there to be something. And for the year, they're expecting about 4.5% in tariffs. Now, GM acknowledged that things are still moving, right? Because we're still in the throes of negotiations. So all of these are estimates. But for the second quarter, 1.1 billion was the number. Now, remember last week in the video, I said that we didn't really see an impact of tariffs on the inflation data, the CPI, and on the consumer behavior and sentiment, retail sales, as well as the University of Michigan Consumer Sentiment Survey. Now, this is different. This is actual impact on cash flow. This is where the rubber hits the road. And this is where it starts and may infiltrate into the consumer prices going forward. We don't know how long that's going to take, and that's why last week I said it was too early to tell. So we're starting to see this. And actually, there's also a domino effect, because if GM is impacted, it's not going to be isolated. NXP also reported earnings last week, and it talked about the lack of demand on automotive chips, and their revenue depends highly on automotive chips. So there is going to be a rippling effect, not just on the companies that are impacted directly by tariffs, but also companies that depend on them and do business with them. Now, GM said something very important, that they don't want to pass down all of the price increases to the consumers. Okay, so last week's CPI, we didn't see it. Who knows what's going to happen in the coming quarters. So what does this mean? How is GM going to achieve that? GM is going to try to achieve that by diversifying and reworking its supply chains to sort of avoid the high tariff areas of the globe, and also by negotiating bilateral agreements with their suppliers to hopefully mitigate the impact of tariffs on GM or any one party involved in the supply chain or the transaction. We'll see what that looks like. What to look for this coming week. We have a lot of economic data on the docket. It's a really important week. So let's see. Housing market, we have the home price index coming in, the Case-Shiller one, mortgage market index, pending home sales index. Housing market has been really in the doldrums. It's been, if you're out in the market for a home, it's been a very difficult time. So we'll maybe do a video covering the housing market at some point this summer. We have GDP coming in for second quarter. This is the first estimate where consensus is expecting about 2.4%. Inflation data, we're getting the PCE. The PCE numbers are the Fed's favorite inflation numbers. They're coming in on Thursday. Now, the Fed is reporting on Wednesday, so this is coming in afterwards. We're expecting about 2.5 to 2.7% year over year. And then on a month over month basis, about 0.3%. It's not that high, right? So, but again, too early to tell. If there's a surprise, either on the upside or the downside, I'm expecting there to be a market action there. We wait and see. And like I said, there's a Federal Reserve decision on interest rates on Wednesday. And the big one is labor market. We get ADP employment data on Wednesday, JOLTS, which is job opening. How many jobs do we have open here in the United States? And of course, on Friday, we get the Labor Department's jobs numbers. This is the one that everyone waits for, the how many jobs did we gain last month, as well as the unemployment rate. Okay, now I do want to hone in on the Fed decision on Wednesday and what to expect, because it will incorporate the jobs information as well as inflation. Now, what's important is about a week ago, the Fed Governor Christopher Waller said something very interesting after he published something called the Case for Cutting Now. And there he was talking about cutting 25 basis points this summer. Why did he say that? Number one, you can read it, definitely. But I'm going to give you the Cliff's Note version. One, he says that tariffs are one-time increase. It's what we talked about last week, right? Two, there's not enough data out there, but there's enough data to suggest that rate should be at neutral. Now, neutral interest rate Fed funds rate is what the Fed considers to be neither stimulating or restrictive. So it's very, very much at neutral. We want to be at neutral, kind of coasting, and that is right now at 3% according to the Fed. Just for reference point, right now we're at between 4.25 and 4.5. So we're about 125 to 150 basis points above neutral rate, which means that we're in the restrictive area. And that's his point. There's reasons to be in the neutral area. He also says that labor market is showing signs of weakness. He says that private sector jobs growth has stalled, and that half of the jobs gains recently have been in the state and local government sectors, where it's not necessarily contributive to the GDP growth. There is a government contribution sector to it, but it is not out there making things, right? So that is his concern. And the fourth is that he expects the second half of 2025 economic growth to be tepid at best. He's not expecting a rebound. So these are his these are his cases for a 25 basis point cut. Now, my reaction to that, thank you, especially in the labor market front. I've been saying for a very long time that the labor market is not showing us an accurate view of, the data is not showing us the accurate view of the American labor market. Now, I'm going to pick on one thing. There are many reasons for believing this. Part of it is anecdotal, what you're hearing. There's some corrections happening in the labor market, in the tech sector especially, but there's just a lot happening underneath that headline unemployment number of 4.1%. That was the last month's, and these hundreds of thousands of jobs that are being gained. That's a statistical game that we play, not necessarily, nobody's going out there and actually counting the number of jobs that are gained, okay? So I'm going to pick on one thing, which is, if you look at the labor markets report, it's about 40 some odd pages long. We only usually talk about the headline number, but around page 22-ish, and this is something I've been watching for a long time, you get the household survey, and you get the number of full-time jobs, number of part-time jobs, and multiple job holders. I've been watching this very carefully because my question in my mind was, how are people making ends meet when inflation, especially for things that are essential like food, gas, and shelter, have been rising astronomically at a pace that is it's hard to keep up with since 2022. And what I've seen is full-time jobs have been falling, the number. Part-time job numbers have been rising. So more people are having part-time jobs, and multiple job holders, that number has been increasing. So that, if I were to take that and extrapolate it, we're seeing a labor market that's not necessarily healthy because we're not creating full-time jobs and we're talking about all Americans here. We're not talking about people who are happily employed. We're having more part-time jobs, so people are making ends meet, maybe making ends meet by having multiple part-time jobs, but maybe even if you have a full-time job, maybe you need a part-time job or a side hustle in order to make ends meet. And of course, multiple job holders. In that case, the number would be increasing. This is not a sign of a healthy labor market. So even if the top line number, the aggregated number may be showing a healthy labor market, we need to be looking underneath the hood to see, okay, are people really surviving and thriving in this high interest rate market? Because think about it, who needs to finance when they need to buy cars? Who needs to finance a home? A lot of people need to finance a home, but a lot of people who really need cars, maybe in order to get to work, they're facing high interest rates. So my take has always been the labor market is telling us something about the health of not only the labor market, but regular Americans. And this high interest rate environment maybe isn't all that healthy, okay? So earlier I said we were at 4.25 to 4.5%, neutral at 3. I think we need to be, we should have been cutting, and I know we started last fall and I was relatively happy about that. Now we need to cut, not to stimulate the economy, because again, I don't agree that we need to stimulate the economy, but to take some of that edge off, that pressure off of a lot of Americans who are maybe holding a lot of jobs to make ends meet. People who need to finance in order to get the everyday things. That interest rate coming down is not stimulative. We're really normalizing toward a neutral. And cutting 25 basis points would get us to 4 to 4.25%, and that is still restrictive. So what do I think is going to happen on Wednesday? I do not believe the Fed is going to cut. And I think considering all things, that's probably the right decision under the circumstances. But maybe come September, we need to start, we'll have more data, certainly on the labor market as well as tariffs. We'll have to start considering, do we hold out for more information on inflation if we start to see more weakness in the private sector jobs market for the rest of the Americans? I think that that's a really important question to answer. And by September, I think we'll have enough data. And I hope that in September, we start to not stimulate, but normalize toward a neutral rate. So that is my take. Last video, I said I would talk about why I think that we might be making a policy mistake. The Federal Reserve relies heavily on data, right? And earlier I said that it's too early to tell with the inflation data coming, et cetera. By the time we have enough data, and by the time the Fed has enough confidence in the data to make a policy decision, economic data are always lagging, and in real time, life happens in real time. And so by that point, it might be late. And so I do expect there to be lag in policy, and that is what I mean by a potential mistake. We'll see, and hopefully there won't be. What I found refreshing about Mr. Waller's statement was that it was on the forward-looking side. It was on the preemptively acting on the side, which doesn't always happen with the Federal Reserve. So I did find that comment and statement, and frankly, the paper, very refreshing. Okay, that's it. We have a lot coming up this week, and so stay tuned. If you're on LinkedIn, please link up with me, follow me. I'll be posting as the data comes out. Okay, thanks so much, and have a wonderful week.